Hello everyone, I'm Bhavik Thakkar, CEO Abans Investment Managers. The objective of this video is to take you through the Abans Global Arbitrage Opportunities Fund, which is a US dollar denominated offering of the Abans Group offered through the Abans International in Mauritius. But before I go on to the product, let me talk about the Abans Group. We are a diversified business group having business interest in financial services, fintech, pharmaceuticals, gold and the related value chain, and also in the commodities transactions globally. The group clocks in a turnover of about $1 billion every year and has a net worth of close to about $200 million. It evolved over a period of time just from being a commodities trading desk to a diversified business group having presence in India, UK, Dubai, Mauritius, etc. Abans International Limited, which is the asset management vertical of Abans Group, is registered under the Mauritius regulation of Collective Investment Scheme and Closed-Ended Fund Regulation as an expert fund. It is a self-managed fund authorized in Mauritius, which offers the global arbitrage fund to the investors. So the share class B of Abans International Limited, which is the global arbitrage fund, why should an investor look at investing in that fund? What are the objectives? The fund's objective is to deliver steady returns in US dollar currency through the underlying transactions into arbitrage opportunities on commodities and currencies which are traded on the global exchanges. Let me talk to you about how does the fund generate return? What are the key activities that the fund does? So as the name suggests, the arbitrage is a transaction wherein you are not taking any kind of directional call. Okay. The simplest, most arbitrage that we can talk about is a cash and carry arbitrage, wherein you buy a physical asset or a stock of a company and sell the future contract of the same, as the future contract has the time value of money inbuilt into the along with the intrinsic value, and as the time progresses towards the maturity of the futures contract, the time value of money becomes zero, and that is where it converges with the spot price, and that unfolds the arbitrage opportunity, right? This is the simplest, most arbitrage that we can talk about. What we do under this fund is something similar but on a geographic arbitrage transaction, right? So let me give you an example. If you look at, say, INR USD as an exchange rate or as an exchange contract, the future contract on INR USD as an underlying across, let's say, two different jurisdictions, that is, say, DGCX, Dubai Gold and Commodity Exchange, versus, say, Singapore Exchange, that is SGX. Let us say if DGCX is quoting at INR USD at 73 rupee 50 paisa, and if SGX is quoting at 73 rupee 60 paisa, how an investor can generate an arbitrage out of this is that go long into DGCX and go short into the SGX, because both the contracts on maturity will get squared off at the same rate, which is the RBI reference rate for the last working day. So their termination price is identical, and therefore what it ensures is that at the time of initiation of the transaction, an investor locks in the profit, right? Another example could be, say, trading into commodities which are listed on the global exchange. So for example, copper across, say, LME, CME, London Metal Exchange versus Chicago Mercantile Exchange. So as a group, we have access to more than 25 different types of arbitrage that we do, which is cross currency, cross geographies, and over last 15 years, what started with just the proprietary fund management has now been under the fund structure since last 4 years. So what it has resulted into is that the fund has been able to consistently deliver close to about 8.5% plus in US dollar currency. And this performance has been supported on a month over month basis because the underlying transactions are very liquid. They are being executed only on the commodities and currencies traded on the global exchanges. So that is the risk profile of the fund also, that it is suitable for investors who are looking at a very steady return from the investment. Also, it is a liquid fund in nature because it doesn't carry any kind of an exit load, it doesn't carry any kind of a lock-in period. So it also helps in terms of the global treasury management for businesses and individual investors who have surpluses to park into on a short-term basis also. fund does not take any exposure to physical commodities. It trades only and only into the exchange traded transactions, which is the commodities and currencies traded on the global exchanges, is where it takes exposure. There is no limitation in terms of the commodities or the currencies that we can trade into. As I mentioned earlier, we have access to more than 25 different types of arbitrage across commodities and currencies. And given the nature of the fund is liquid, okay, the underlying transactions are also executed for tenures which are anywhere between 1 to 3 months. That is the derivatives transactions executed within 1 to 3 months to align with the objective of the fund, that is, providing liquidity to the investors as and when it is needed. So, given that the fund does not take any kind of directional call, the key risk involved in the fund is that if the commodity or the currency price was to get affected only in one market, okay, so that would disbalance the entire arbitrage opportunity. But a mitigation to that is that the world markets, have been working in sync, and a case in point here is that the crude oil price in the month of April 2020 went into negative territory, because of the specific storage related problem in a particular territory in US. While the storage problem was only specific to that territory in US, the prices world over went into negative territory, right? So this is possible because of the very presence of the arbitrages world over. And to that extent, it helps the fund mitigate the risk. Another risk is that if everything was to be sort of priced perfectly and there is no arbitrage opportunity, but at our level the mitigation is that we have access to more than 25-30 different types of arbitrage that we do, so we are not dependent on just one particular commodity or a currency, to generate returns from the product. The fund invests all the money, all the corpus of the investor is placed with the exchange as margin, and there is no other utilization of the funds, such as putting into liquid funds or any kind of a liquid assets. So the entire corpus is being utilized to maximize the returns that it can deliver, through the exchange traded transactions. So, in the current context where the economies world over have been facing zero or a very negligible interest rate, this product becomes a good yield enhancer onto the investor's portfolio as it generates very steady returns through the arbitrage transactions. So, thank you so much for taking your time out to listen to the video. I hope you have got a good idea about what the fund is and what is the investment strategy, how we have been performing. And thank you so much for the time.